In this video, we're going to be taking a look at how to forecast the financial statements. So this is a very important part of the valuation process because it will have an effect on the valuation methods. And we want to get an idea of where the company's numbers are coming from and what their trends are moving forward for the forecast. So looking here at Sherry's financial ratio analysis, we can get an idea of all of these ratios and what they look like. We can see that the SG&A is a percentage of revenue, gross margin, obviously, depreciation is over PP&E. We can sort of see the stability of these ratios and their trends, and then we could use those moving into the forecast. So this Tractor Supply Company, ticker TSCO, this valuation is a super good example if you're looking for a template on how to perform this forecast. So we always start with the revenue growth rate in the income statement. And to find this rate, you do have a couple of options. It's a good idea to look into the 10K, the earnings transcripts, and the quarterly reports to identify any forward-looking statements that can potentially affect your year-to-year growth rate. Otherwise, you could use a capital growth rate, as we see here, or an average or a rolling average. So if you use the capital growth rate, if we look at how this is structured, you have your number of periods, and then your present value, and then your future value here. And this rate can be used to forecast moving forward. We can see here that as we move on, we have the percentage of growth slowly decreasing. And over time, we want this to converge to our long-term growth rate. We also have a 7-year and a 5-year average here and a median to sort of get an idea of what our data is telling us. We can see that more recently our revenue growth here is decreasing, and we can see that our median sort of smooths out any outliers. So if we were to use, let's say, the 5-year average instead of the capital growth rate, something I would recommend is to look at the standard deviations for the growth rate and sort of make adjustments based on that towards the terminal growth rate as you move on. You could do, for example, the average minus 1 standard deviation for this year, and then 2 for this year. And, that won't work out every time, so you could even use half a standard deviation just to sort of move towards that terminal growth rate, which is typically going to be the long-term GDP growth rate, which you could find on Google, around 2.4%. So if you were to take a rolling average, what that would sort of look like is taking an average of either the last 3 years or the last 5 years. For the purpose of this example, we're just going to do the past 5 years. So we can see here that has affected this, and then we could carry this forward to keep that trend. So if for whatever reason a company was going through some sort of restructuring or introducing a new product line, we would want these recent numbers to have more of an effect moving forward. So for that reason, a rolling average would make more sense. And if there's a very recent trend, for example, the last 2-3 years, we could switch this to a 3-year rolling average to capture more of that moving forward. So another thing to keep in mind is that Bloomberg will often loop all of the revenue a company earns into one umbrella here, sales and services revenue. So what you can do is sort of look into the 10Ks and break this up into different segments, and then you'll sort of have an idea of where the company is getting its money from, which segments are generating the most revenue, and you could sort of make the ones that are big contributors towards the total revenue grow faster or grow slower based on what you read in the 10K to get a more accurate valuation. Moving on to the costs of goods and services, or COGS, we'll want to take this as a percentage of the sales because these two are linked pretty heavily. We could see here that this ratio is pretty consistent, varying around 65 to 66%. I want to stress that we really want our percentages to be stable when forecasting, because if it's very bumpy moving up and down, it can be kind of difficult to forecast it accurately because you don't really know which years you want to keep and which years you want to leave out. So moving on to our gross profit here, our SG&A expenses, we're going to want these as a percentage of sales too. Line by line, you're going to go through and look and see if you see any abnormal jumps, increases, or decreases. Most of those will have an explanation in the 10K or 10Q. And you'll know if you want to keep these one-time jumps in or take them out when you're doing your forecast. A potential reason to keep it in would be perhaps like an acquisition that's going to bring in more revenue for the company, or maybe an acquisition that elevates some costs. It works on both ends there. But one-time things like, for example, suspending a service for a particular period of time, doing some restructuring that could elevate costs for one period, those things you don't really want to include in your average or your stable rate, whichever you use. Those aren't really going to affect the valuation moving forward in the next 5 years. You're probably not going to have another big event that's going to cause a huge jump. So unless this is something that the company is going to keep, like an acquisition, then it's better to just leave those outliers out of your forecast. So moving on here for SG&A, this is going to be a percentage of sales. So these are going to be linked, like the cost of goods, to the revenue. So taking it as a percentage of the revenue is going to give you a relatively stable ratio that you could use moving forward. I want to mention that here in this example, we have a sort of a multiplier moving forward, and this is something you could do too, just to slightly adjust the number depending on what you see. I typically like looking at the growth rate each year of this ratio, so taking a growth for the percentage of sales each year and seeing how that moves. If it's stable, I'll apply it moving forward. There's a lot of different ways you can tackle this, but something I wouldn't recommend is to just slap on an average for all of these years, because that's likely not going to happen. You want to be consistent and make sure it's as accurate as possible, so just doing an average and calling it good isn't really going to accurately forecast this, and it'll take into account everything historically. And that's not the best method moving forward, because a lot of things change with technology and innovation and the structure of businesses. So here we see depreciation and amortization as a percentage of sales. You could also take this as a percentage of your balance sheet assets, and we'll move into the balance sheet a little later and see how that's forecasted. But typically the depreciation and amortization is going to come from your assets, so your PPE and other intangible assets like patents and stuff like that. So after that, we're going to get our operating income, and you're going to want to calculate this by taking your revenue and subtracting your cost of revenue all the way down to this number. So as you can see in the formulas here, we have our calculations being done by looking at the operating expenses, and all of these are calculated all the way down so that we have a consistent number. The template is going to be from Bloomberg, but you're going to want to go through and make sure your formulas are right in calculating these numbers. So once we have our operating income, we can see in this example, we have our EBITDA, earnings before tax, depreciation, amortization. So we see this was plugged in here so we could see the margin and the formulas here. This isn't always necessary, but it's something that's super helpful and recommended to do. So we have an idea of what that margin looks like, and we can carry that margin going forward. So next we have our interest expense. And this is always going to be a percentage of the debt, just like we have earlier. We want this to be linked in a way that makes sense. Revenue is going to be generated based on the assets of a company. SG&A is going to be a result of the sales, right? Depreciation and amortization is going to be a percentage of your property, plant, and equipment and other assets that require depreciation. So your interest expense is going to come from your debt because you're borrowing money, you pay interest expense. So we can see that ratio sort of decreases over time, and it seems to be a little stable here. Another thing that I really like about this example is having these 7-year, 5-year, and median averages. So we can see here that in the more recent years, it's around 4%, so this is sort of continued forward. It's very likely that there was something said in the 10K about the borrowings and what that schedule looks like for interest expenses. So moving on down, we then have our calculated pre-tax income, and then slowly all the way down to your net income. This number is going to be used once you start your free cash flow projection. So also we want to mention our tax here. We have our current income tax and deferred income tax. Typically, this is going to be found on value line, what the effective tax rate is, and then you're going to take that and then calculate that there. Typically, your current income tax is going to be that, and then your deferred tax is going to be a percentage of your current income tax. So we can see the tax rate is calculated at the bottom of the sheet here. But yeah, using the effective tax rate is a good method, or if you're unable to find that, or if there's some information in the 10K about taxes, then using that number is a good idea moving forward. So this sort of concludes the income statement aspect. just making sure everything makes sense and you don't really have one number. You don't want the average to be too long of a period because a lot changes in 7 years plus. 3 to 5 years is typically good, 7 if it's very stable. But yeah, you really want to find the stable rate and you really want to look into the financial statements to see if there's any forward-looking statements of potential acquisitions or certain segments that are going to get discontinued. If you break up this into all of the different accounts, you could get a really good idea of how the company operates and what percentage of expenses are attributed to which segment. You could forecast those individually and then get a number based on that. So I know when I did my valuation for Capital One, I read that they were discontinuing their home loan business. So I saw that their home loans went to zero at the latest year I was forecasting. So moving forward, I kept it like that because an average wouldn't make sense for something that is going to be out of the picture. So you want to keep it at zero. And those are just little things you want to look out for when you're reading through your financial statements. If there's anything that's being discontinued or added, you want that to be reflected into your 10K. And keeping notes about that too, you could just left click on it, do a new note, and it'll help you explain those big jumps, big decreases once you're doing your presentation. So once we have our income statement forecasted, we're going to want to move to the balance sheet. So cash is going to be a percentage of your sales because that's typically where the money's coming from, right? And we can see here that the different forecasted things are going to be linked to what makes sense. Inventories are going to relate to COGS. Short-term assets are going to be a percentage of sales because those contribute to your sales. PP&E, percentage of sales. Depreciation as a percentage of PPE. As you move forward, you're going to want to find these stable ratios again. And if you don't, you're going to want to try things that will help you find those. All right, so we see in the balance sheet here a pretty similar pattern of using a stable ratio and moving forward with our averages to get an idea of what the trend looks like. And as we're forecasting this, we would want to do each line and continue the zeros if we continue to see zeros. But splitting it up and really forecasting each line is going to help you the best in terms of really understanding all the components of the business. So once we have those, we could sort of add up our current assets. You can see here with the ratio what we're adding up. We have all these values, and then we'll do the same. And once again, just keeping in mind the fact that these forecasting these different segments, it has to be with something that makes sense. Inventory can be accurately forecasted with cost of goods sold because your cost of goods sold is going to be the cost of your inventory. And same with short-term assets, for example, your short-term assets are going to be generating sales. So taking those as a percentage of sales, you could sort of play around and see which ratio is the most stable and continue that moving forward with slight adjustments. So moving on to like property, plant, and equipment, we can see that accumulated depreciation here is a percentage of PP&E because that's what it's going to be, right? Then we have our non-current assets here being added up, and that's continued forward, and then we could sort of sum up our total assets here. Something to keep in mind also is the way the assets are moving. One thing here, when you forecast using the income statement, you could see a big jump in your total assets for your forecasted year. And you want to make sure that this isn't for no reason, right? There has to be some sort of acquisition or maybe something that is driving this. So we could see here that long-term investments and receivables, it's possible that the company started investing or acquired receivables from another company through an acquisition, and that has added to their balance sheet here. So make sure that once you're done forecasting the assets, that this jump is justified or doesn't exist if it isn't justified. Moving on to liabilities and stockholders' equity, we can see that the payables and accruals are forecasted using a payables turnover, short-term debt as a percentage of sales. All of these are going to be calculated based on something we see. So we see here these jumps likely because of an acquisition, right? Just like we saw our jump in long-term investments and receivables. So we can see here that we have some more jumps here. This is because the company was expanding. So we can see here, obviously Tractor Supply was going through expansion and acquiring new assets and liabilities. So forecasting this is going to be pretty difficult you'd want to look into the 10K and see what the debt repayment schedule looks like and put that into your forecast. So keep in mind that as we're moving down, these are all going to be calculated on your own. You're not going to take these from the forecasted Bloomberg terminal numbers. Using those numbers is a good guide to get an idea if you're on the right track, but you're going to be reconstructing this on your own, with of course the help of us if you guys need it. And yeah, so your equity is going to be obviously your assets minus your liabilities, so, because you want this to balance out. And like I said, just looking at these jumps and making sure they're justified is important with this approach. For this example in particular, the revenue growth method made the most sense. And sometimes, looking at this growth rate, it might not be this stable. It might be all over the place. And then forecasting the assets and the rest of the income statement can become really difficult. When you run into this problem, it may be a better method to forecast assets and look at the growth rate of that and then take revenue as a percentage of your current assets. So there are always different ways you can approach this situation, but you want to make sure it makes sense and you want to make sure that it accurately reflects what the company is doing moving forward. So once you have these forecasted, you could plug them into your valuation method.